Germany's banks have had a tough week. Deutsche Bank, the country's largest lender, saw its share price drop sharply on Monday and Tuesday following news of a possible $14 billion fine from the U.S. Department of Justice for misselling mortgage-backed securities before the 2008 crisis. On Thursday, Germany's second-largest lender, Commerzbank, announced plans to cut nearly 10,000 jobs and scrap its dividend as it undertakes a strategic overhaul. And in between, European Central Bank President Mario Draghi spent much of Wednesday at the Bundestag enduring a grilling from German lawmakers convinced that his monetary policies are undermining their country's economy. But even with the week it had, Germany's banking sector is not alone in its problems. Deutsche Bank's struggles did not begin this week, of course. Like so many of its peers, it spent much of the decade leading up to 2008 getting further and further away from its roots in retail banking, trading ever more exotic and complex derivatives across the Atlantic Ocean. Its profits grew until the great financial crisis threw back the curtain on its new products, which turned out to be composed entirely of other complex products without real value, and the whole structure came crashing down. Deutsche Bank emerged from the crisis with a balance sheet more loaded with exotic derivatives than most, an opaque mixture of products that are both hard to value and easy to disparage, considering the experience of 2008. Since then, the bank's shares have been on an inexorable downward slope, falling from €50, about $67 at the time, in 2010 to just over €10, about $11, on Tuesday. The most recent drops have taken share prices low enough to set alarm bells ringing. Over the weekend, a German magazine reported that Chancellor Angela Merkel had met with Deutsche Bank executives to discuss a possible bailout. The government and bank both denied the reports, but the damage was already done. Newspapers around the world took the rumor and ran with it, publishing stories of 2008-style government bailouts and systemic dangers. In truth, these fears are probably overblown. For one thing, there are other steps Deutsche Bank can take before resorting to a government bailout. It could, for instance, go to the market in the hope that shareholders might be willing to pump more money into it. Failing that, if the bank's share price continues to drop, other German institutions may agree to pool together and provide